Okay, the 5 strategies, just a summary of that. Then we will go with the 6th strategy till the 11th strategy in our class today. Okay, so this is actually a summary. We had learned about 5 strategy. The first one is the basic strategy where a person is going to buy a long call, the right to buy an asset, underlying asset is something which we call as long call. And so the action is buying a call. Then the second one is short call, when you're when you're very sure that the market is going to go down, you might go with a short call, and where you're going to sell a call. So that's also a basic uncovered option strategy. Synthetic long call is nothing but you buy a stock anticipating a a bullish market, and you expect that if at all the stock went down, what am I supposed to do? I want to protect myself against the fall in the share price because I already own the asset. So what I do is I will buy a put option also. A put option is nothing but buying a put option. Long put is nothing but you have the right to sell the asset. So if at all the price is having a downward trend, you are just protecting, covering that with a put option. Okay, so that is synthetic. It more or less resemble a long call option strategy. That is why it is called as synthetic long call. Now, long put is nothing but you buy a put option, that is the right to sell an asset. So the other party on the side is under an obligation to buy the asset from you, the underlying asset from you, if at all you're going to exercise your right. So that is plain uncovered strategy. Short put, again, it is another strategy which you use where you get a premium. Your risk is unlimited because the other person should be definitely going with exercising. Short put is you are selling your right to sell the asset to some other person. So that person would be exercising the right to sell the asset when the share price is trading down. Right. So that is actually risky for you. You are being compelled to take up an asset when its share price is much lesser than what is available in the market. So that's what we call as short put. So this is the summary of 5 strategies which we had discussed in our last class. Now let's go to the new ones. Today, I think you will feel it comparatively easier, but every new strategy which we are going to learn is actually pitching on these basic options. It's actually a different combination based on these. Okay, so that's why you might feel it a little easier. 6th strategy is covered call. Now here, what happens here is you're selling a call option on the share you actually own. Okay, you have a you own a share, you actually buy a stock, and you have it with you, and then you are selling a call option. Now why do you sell a call option? You give the right to the other person to buy the asset. Now when will the other person exercise the right? When he is able to get the asset at a lower price than that is available in the market. So what will be your expectation? You are neutral or moderately, because you know that the market is going to be sluggish, going to be bearish for some time, but later it will go to a bullish trend. That's why you're ready to purchase that asset at a lower price. You're ready to do that because you expect that for time being the market is going to go down. And another thing is you are getting a premium. When you're selling a right, you're getting a premium. So that's why we say that the maximum risk is your stock price, because you already own the asset. So your stock price minus the premium received when you are selling your call. The reward is limited to your premium. Of course, when you have a difference between call, if that is exercised, okay, if the call is exercised by the other party, then it will be the difference between the strike price and the as you say, strike price and the stock price plus the premium, if there is a difference. Okay, maybe you have bought that stock long back, right? So you were able to sell that at no, even though you expect a bearish market, the price may be a little higher, right? So that depends upon the condition prevailing in the market. And as you say, no, the Break even for you always would be you have already paid your money when you purchase the stock. That minus the premium you got. Right, because you're selling the call option, the right to buy an asset. So when somebody is buying an asset, of course, your obligation as a writer of a call was to sell that. Right. So that's why price paid by you at the time of purchasing minus the premium. Now let's look at a real-time example. So here, buy stock, sell call option. That's the strategy. Buy stock at the rate prevailing in the market. Maybe the spot rate when you are buying, that is applicable. Buy stock, you keep it with them, and then you sell the call. Most of it would be out of the money. Now, why do you call when you are selling a call? When do you call that as out of the money? Yes, when that is why you are very bullish about the market, and you actually don't want to sell that. But if you get a good strike price as your profit expectation, you're ready to exit the market. That's a out of the money means the current asset is available at 2050, but you're going to sell your call at 2,500 for 3 months period. So that is the kind of profit, that is a kind of increase in share price which you expect from your asset. So you kept your strike price at 2,500, and then the other party would be exercising the right if the share is about 2,500 in the market. That's why it is called as out of the money. Now the share is having a price of 2050. So it is out of the money. You're selling the strike price at 2,500, but this person could have bought that from the market at 2,050. Right. So you have a 3-month period, and you expect that if this become in the money, then only that party would be exercising that. If the share price, current spot price on the expiration date should be more than 2,500. In fact, it should be more than 2,600. Then only the other party would be exercising that. So if that is being exercised, you're happy with it because that is the profit which you expect. So that is why normally in this strategy, what is happening here is the strike price generally would be out of the money. Right, out of the money means it will be higher than the spot price of what is trading. That is why we call that as out of the money. But if the price increase, if the price of ACC Limited increase and goes beyond 2,600, you can expect the other party exercising his right and you're selling it. In that case also you are happy. Why? Because you got the right kind of profit for your investment. And of course, the break-even point is nothing but it is actually your stock price minus the premium you got when you sold your call. So stock price was 2050 when you bought the asset minus 100. That will be your break-even point. Okay, so that's it, and it is expiring in 3 months period. That is the expiring which we. So here this strategy, as we call covered callers, you have an asset. You're covering the possibility of fluctuation in the asset price by selling a call. By selling a call. But in that case here, what you have to remember is your strike price will be in most of the case OTM, out of the money, because you expect the market to better in future and you expect that the share price is going to increase. So you will keep the price at a higher rate. That's what you have to remember with respect to a covered call. Right? Now we are moving further. Now the next is long combo. This is very, very simple to understand. It is nothing but you are selling in out of the money put, you're buying in out of the money call. You're selling out of the money put, okay, out of the money put in the sense, when does this out of the money put becomes in the money? When the share price goes down. Right, when the share price goes down, suppose if your strike price is 5,000 for selling selling this asset, if the strike price is 5,000, this person would be willing to sell the asset when the price is below 5,000 in the market. So that is out of the money. if suppose if the market price is, as you say, 6,000 or 7,000, this person will not be willing to sell, so it will be out of the money. Okay, so if the price is going below the strike price, it will be, that's what we learn, it will be in the money for selling. But the opposite is with respect to buying. Buying an OTM call, when do you exercise it? When you expect that the share which you have it is actually possessing a price lesser than at what is available in the market. For example, if the strike is 5,000 and if the same asset is trading at a rate of 6,000 in the market, definitely you will be exercising your call. You will be exercising the call in such a way that you can get the asset at a lesser cost. But now, what you have to remember, that this person is buying in out of the money call. Why? Because he is expecting a bullish market, and the premium for out of the money call would be very less when compared to in the money call. So he is working on his expectation. His expectation is this market is going to have an increase. So when he buy an out of the money call, okay, he gets that at a lesser premium. And what he has to remember is, if the strike price is much lesser than the spot price, the future spot price, this will become in the call. So he's bullish. The price can go up. That's what he expects here, right? So since he is bullish, selling an OTM gives him less risk. Why? Because the person would be selling the asset only if the price goes down below the strike price for selling, right? So here what you have to remember is the risk is unlimited, because these both transactions are based on his expectation. If it does not happen as he expected, if the market is, as you say, the market did not go as he expected, he is going to be in a long trouble, especially with selling an OTM. Okay, selling in the sense he is selling his right for a put. So definitely if the other party exercise, he has to provide this asset. He has to provide this, or as you say, he has to go with, he will be selling the asset to him. Naturally, what is happening? He needs to go with buying that. Right? So the reward is, as you say here in this case, if his expectation goes like that, it will be unlimited. Now the break-even point here in this case is higher strike plus net debt. Net debt is nothing but the premium paid and premium received. When he is buying a premium, it will be, as you say, when he is buying a call, it will be premium paid. When he is selling a put, it will be like premium received. So the difference between that, whatever is credited to his account, that will be net debt. The difference between premium received and premium paid. And higher strike, normally that will be for call. Okay, so let's look at with an example. So that will be very very easy for you to understand. But what you have to understand is only two things happening: selling a put and buying a call. That's the thing which you have to remember. So here what happens here is sell OTM put and buy OTM call. So sell put, here what you will happen, what can happen here is, this person, as you say, initially this, since when you are selling here, this can happen in both the ways, by short selling, or short selling is without possessing it, that becomes little more risky, or he can go with owning the asset and then selling an OTM and buying an OTM call. So that both depends upon the condition. This particular example we are explaining with buying, this person already bought the stock, and here he sells the put. Now you have to remember, sells the put at a strike price which is out of the money. See, the market price is 2050, but he is selling at 1900, which means it is out of the money. because he expects that there can be some risk that is going to happen. And the premium, when he sells, he receives the premium of 10 rupees. Now buys call. Now buys call at a OTM, out of the money. Why? Because currently the market share price is 2050. He could have got the same asset at 2050, but out of the money call, which is 2200. Now what is happening? In 3 months, he is expecting that this will become in the call, because he's having a bullish expectation. So it is actually covered call. He can take both the stand. Okay, he sells put. So in this case, if this person would be exercising this, right? Exercising this, if the price is trading, current price, this 2050 becomes lesser than 1900. Okay, becomes lesser than 1900. And then what you have to remember is, in that case, he will have to go with buying that. But he is very bullish about a market. So he expects that when he get the asset at a lesser price, in future, the price is going to increase. So you start making profit when the price starts increasing. That's the primary thing what you have to understand. So it's actually a covered one. Okay, now what you have to remember is buying a call. So this person will be exercising this only when the current price is, this is also out of the money, because you could have got that at 2050, you're buying at 2200. But what you expect is, in this period, during this 2-3 months period, this 2200 would be increasing. This 2200 would be increasing to a greater heights. In that case, he can make profit. He can get the asset at 2200, which is costing more than that. He will exercise, or else he is going to lose his money, which he has paid as premium. But in this case, the premium would be comparatively lower than in the money calls, because he have chosen an out of the money. But the risk is unlimited. He is taking up a lot of risk. Everything based on his expectation. If at all his expectation didn't work, unlimited loss. The money he has invested here. Here, if this 2050 is invested, he is having that. Imagine that he owned the asset. He has agreed to this person that, yes, I am ready to sell the asset to you at 1900. Now, this person would be exercising this 1900, maybe when the asset value is 1000, 1000, because he sold his right. So he is going to lose the whole, maybe 50 or 60% of it, if he is selling the asset, which is just having a value of 1000 at 1900. So that is the risk involved in this method. Okay, selling and out of the put. If you understand one concept, it is very easy for you to understand the rest of it. Selling out of the money put and buying out of the money call. Okay, so that is this strategy all about. Now we are going to the next one. Strategy 8, strategic call or synthetic long put. We had learned synthetic long call. Right, now we are going to learn synthetic long put. It is just the opposite of that. Here what happens here is, you will start selling the asset, expecting that you can buy at a later stage and satisfy that. So without owning a stock, short on a stock and buys a call. So you sell that without owning, and then you buy a call from the market, where you expect that you can buy that from the market if the other party exercise it. Okay. So that is short. But what you have to understand here is, short on a stock is happening in a spot market. It is not happening in a derivative market. You do that in a derivative market. You actually make your sale in a derivative, in a spot market, and you enter into a derivative market. That's how it is happening. That's how it is happening. So what we are going to say is, here in this case, yes. Yes, here in this case, what we were saying is, here the strategy is like this. He sells stock. Okay, he sells stock at 2050. Actually, he is going to sell the stock in a as we say in a spot market, and then he is going to buy the call from a derivative market. So when he is buying the call from a call option, okay, call option from a derivative market, he is actually paying the premium. And what you have to understand is the strike price in this case. When you're buying a call, if the market is bullish, the strike price would be higher. That's what we said. Here he is expecting, he is having a bearish market expectation. That's why he thinks that he can sell the stock and buy from the market at a lesser price. But unexpected rise in the price of stock, the loss is limited. Okay, so risk is limited. Reward maximum stock price minus call premium, because you have sold the stock and you expect that to buy from the call market and sell to that party, because short selling is a temporary adjustment which you make with your broker. Your broker is actually lending for you to sell that. You don't own the stock in the spot market, but you're based on your credibility, based on your track record in your transactions, your broker is agreeing for selling that. Actually, your broker, maybe Hedge or Geojit or Sharekhan or some broker firm, they lend you that much share and you sell it. And your promise is, yes, you're going to buy back that on a future date. That's your expectation. Now, that is something that is happening in a spot market. What you're going to do is you're going to cover up that with a instrument from the derivative market by buying a call. Buying a call means you are getting a right to decide whether to buy a particular asset or not. So this is a risk. You are trying to shield it. Now, how do you shield it? You know that when you short sell, you have to buy it back at a certain time, or maybe you have to supply to that person from the market by buying from the market at the real time price. So there is a risk that is expected as the price of the share can go up against your expectation of a bearish market. So you are covering up that risk by buying a call from the derivative market at a strike price. So you're blocking that. If you want, you can exercise it if the spot market is with higher share price, you're blocking that at a certain level. That's what you're buying a derivative call from the derivative market. So the reward is maximum stock price, how much ever you are spending for buying that minus the premium you get. In fact, if that does not happen, you have something more in your hand. As you say, you can own the stock, right? You can buy back the stock and have it with you. So this is why we say that maximum stock price minus the premium you pay when you're buying your call. And the break-even point, of course, the stock price minus call premium if you're owning the asset. Because you are selling the stock, short selling the stock, right? At that time, you will get a money. You're paid with the money. And then later, at a later stage, you're buying it or maybe exercising from the derivative. Now, let's look at with an example. So, you sell the stock at current price, that is 20.50. But you expect that later you have to pay that or buy back that. So what you do is you cover up that risk of increase in the share price from this position by entering into you're trying to protect it. Maybe you will lose little money, but still you are secured from a big loss. That's what you do by buying a call from the market. Now, if you want, you can exercise. If the things are normal as you expected, if the share price went down from this rate, like 2050 became 1,900 or 1,800, you will not exercise this call. You will not exercise this. In fact, you will buy from the spot market itself and you will settle it. You will settle it with the broker. So that is why this is actually covering up your risk that is exposed, that you're prone to in the spot market by participating in the derivative market. So that's why short stock that happens in the spot market, you're short selling without owning by having an arrangement with your broker. And then you are buying a call expecting that can be compensated if at all things do not happen as you expect. So the break-even point is always the stock price minus the premium you pay. So this is what we call as the synthetic long put. It resembles long put to a great extent. That's why it is called as synthetic long put. And in fact, it is just the opposite of what you say, the long synthetic long call. Because there you buy, you expect your asset value can go down, so you enter into a put. You buy a put. But here it is just the opposite. So it's very easy for you to learn if you understand one by one. Okay. Now that's it. We go for the ninth one, right? Our count is nearing to the end. We go to the ninth one, and in the ninth one, it is covered put. As the name indicates, this is a covered strategy where what you have to is one more thing. It will be better if I explain from this. This part you can check. Okay, short stock, short put. It will be better if you understand that. The only difference here is short stock, buy call option. Okay, but here what happens here is short stock, short put. Now you can read this. That will be easy for you to understand. The investor shorts a stock because he is bearish about it, but does not mind buying it back once the price reaches. That is, it falls to a target price. This target price is set as the price at which the investor short. That is put strike price. Okay. So short stock means short selling without owning. Short put is nothing but I just showed you the previous one so that you don't get confused with this one. No, there is a printing error here. It is actually the whole thing, man. 1 second. Sorry. Yes. Now it is correct. Okay. So what I was talking about is in this strategy, I think it will be easy for you to know if I go with explaining from the example. Sell stock. Okay. He sells stock which is currently 50. He sells it now what do we say it is short stock? Because he is not owning that. He sells it. Now when does that selling happen? When you're bearish about the market expectation. That is, you're neutral or moderately bearish about the market. Now why do we say as moderately? I'll tell that. Okay. So he's moderately bearish means for the time being he thinks that the market price is going to go down. That's why he sold it, expecting that he can buy from the market at a lesser rate. So that's the first step that has happened in as you say, in a spot market. Now he sells a put. When he sells a put, you know that he is actually selling his right to exercise selling an asset. He is actually giving away his right for selling the asset. So when he is giving away the right to sell the asset, he's taking up the responsibility of buying it from the other party if he exercises it. That's what short put all about. Now this person keeps that's what you have done. This person keeps the strike price of the short put at a level where he expects the target to buy that asset in future. Because he is expecting that this is going to be a bearish market, the share price of the asset will fall, so he is trying to protect from it. Okay, so he short sold it, expecting the asset to be bought at a lesser rate and settling his transaction in the spot market. That's clear. But then he covered that position by entering into the derivative market by taking up a different strand. Now, what is that strand? He expects that if the share price goes down, if the share price go down, when does this now when you're selling a right to sell the asset, when does the other party exercise that right? When the asset price is much below the strike price. When the asset price trading in the market is much below the strike price, then only that first party will be agreeing to sell the asset at the strike price. So what you have to remember is this person, the person who is selling the right, has carefully planned and kept a strike price at which he is ready to buy that asset. Because he knew that the market is temporarily bearish, but in future, this asset is going to perform well. Maybe it is nifty, or maybe the share of ACC is expecting that it is going to go up. So for a temporary profit, he has entered into this position. That is short stop, short put. So now the market is bearish, but he doesn't. Now, if things did not happen, if the share price did not go as below as he expected, what happens here is he's left with premium. Simply he's left with premium. He can have it. He did not buy the asset. He is losing only. He is actually in a good position where he can, as you say, he can buy the asset. It is short stock. So the risk is there. He has to go buy the asset. Maybe sometimes the risk is the asset price can go up. In that case also, he is in a loss. He can buy the asset from the market and settle his claim with respect to spot market. But in derivative market, he is left with, as you say, no premium. If the asset price went down, he is having some premium. He's not in a total loss in derivative market. But short market, in the spot market, but because of short selling, sometimes he might be in a big risky position where he had to buy the asset at a higher cost and settle the transaction because he has short sold it without owning the asset. So that is one risk he is there, he's facing, but his expectation is for the time being, the market will be little bearish. The risk is unlimited because if his expectation is not going to happen, he's going to have huge loss. Right. That's what now I think you will be able to understand. He is moderately bearish, unlimited. His risk is unlimited if the price goes up. Right. So sale reward is definitely the sale price of the stock minus the strike price if the other party exercises it, plus the premium he got from the derivative market. And then the break-even point is the sale price of the stock because he had already sold it. So sale price plus the premium he get in the derivative market. So that is actually what we call as covered put. We had learned covered call, just the opposite that happens in covered put. So while learning, compare it and learn, it will be easy for you. Okay, so this is covered put. Then the last one is very easy to learn, long straddle and short straddle. Long straddle is a condition where you know that market is swinging, but you know that it is swinging like this, volatility, but you don't know where it will fix, whether it will fix at an upper mode or at a lower mode. You're not sure. You're not sure about the direction of the swings in the market. In that case, you will go with a very, as you say, covered position, as you will be buying a call, expensive. When you buy a call, you have to pay. When you buy a put, you have to pay. So it is expensive. But you are very conservative. You will take up a simple, comfortable position by buying a call and buying a put with the same strike price and with the same maturity. So if the swing fix this part, what you will do is, if it is in a higher mode, you will exercise your call. You will be able to buy the asset at lesser cost. If the swing fixes at a lower part, you will be exercising your put because in that case, you can sell the asset at a higher price. So this is it. So long straddle, you have to remember the swing, volatility. Long straddle is a case where you will see the market swinging both the sides, but you don't know where it is going to fix. So you will move in both the directions. Let the market be fixed here, I have a strategy. Let the market be fixed here, here also I have a strategy. And what you expect is the investment is huge, the premium paid is huge, but what you expect is you can cover up all that from the profit you make with the other strategy. So here the reward is unlimited. The risk is the amount you have paid as your premium. Anyway, the market will not, you know that there is volatility. It's not stable. So you know there is swing. So that's the type of benefit you take by going for long straddle. And here you have an upper break-even point and lower break-even point. And upper break-even point always will come from this the strike price of your long call. So that's why strike price of long call plus the net premium in your account, and lower break-even point is strike price of the long put minus the net premium paid, because I get 5,000, but actually I'm not getting 5,000 because I already paid 100 or 1,000 as my premium. So I have to deduct it. That's why net premium paid. Because this is a combination, that's why we come up with the concept of net premium. Okay, you will have to pay for call and put. So net premium. Right. Buy put, buy call. It's very simple to understand. Call and put at the same price. Upper break even point. Upper break even point would be 15,700 plus 200, 15,900. Lower break even point for this would be 15,700 minus 200. That's 15,500. Okay, so that's what we call as buy put, buy call, long straddle. Now we are going to go over the short straddle, which is very much similar but little different. Okay, here you don't know, the swing is absent. You remember, I'm just showing you some no, for you to remember it easily, some maybe verbal, something like that, so that it will click fast when you are writing and when you're learning. So here there is no swing. What they expect is the market is going to be static for some time. No swing, no volatility. It's more or less just for the sake it will move, again come back to the same time. Same thing. So you want to actually take a risk and earn something during that time. You don't want to stay in the market without earning income. So what you do is you go with selling a call and selling a put with same strike price and maturity. So it's just a more or less it's just the opposite, but the concept is little different. Previous one, long straddle, the market was moving, you want to cover that, you took a safer position. But this is a risky position. You believe that the market, this is going to be like this for some time. That's your anticipation. And what you did is you took a very risky one. You sold the call and you sold the put. And if the market is not moving as you expect, if the market is not static as you expected, your loss is unlimited. What you will have is only the premium. Why? When the other person is selling a call, what happens? You are selling a call, what happens? The other person would be buying the asset if he or she thinks that the asset, the strike price is much lesser than the price of the asset trading the market. So if in a bearish market, again, you will have to buy the asset at a higher cost and sell to this person on settlement. Now, in a bearish market, if the market went this side and fixed here, the other person would be exercising that. Put, selling a put means you're selling the right to other person for deciding on when to sell the asset. The other person would sell the asset when the price went down below the strike price. Right? So again, you are in a problem. You have to buy an asset possessing a very less value by paying the strike price. So that's something, that's something what you have to incur when you go with a strategy called short straddle. That's why it say that, of course, the upper break-even point is strike price of short call. Always that will be a call. Then plus net premium received. Lower break-even point will be strike price of the short put minus, of course, this is from a buyer's perspective. You know why? Because this is something that is exercised by him. So net premium paid. So the break-even point is actually in both the cases. It is applicable for the buyer of the call and put. Anyway, this person does not have a stand. Whatever the step taken by the other party, the person has to follow it. Right? So that's it. And yes, this is with an example. Call and put strike price 15,700. And then the premium received is 200. Upper break-even point is 15,700 plus 200. Lower break-even point is 15,700 minus 200. That's it. So we had discussed in our class, as we say, 6 more strategies. 6 more strategies. In that, more or less, some of it is just the reverse, like long straddle and short straddle, covered call and covered put, synthetic long call and synthetic long put. It's more or less just the opposite. It is very easy for you to learn. Okay, and I'll just go with a quick recap before I give the baton to you. So strategy 11, as I said, it will be short straddle. What you have to remember is sell put and sell call. This person is expecting the market to be static. So he is taking up a unlimited risk of selling the put and selling the call, where he expects that nothing is going to happen because the market will be like that and this person will not exercise it. So he is left with the premium. That's his expectation. But if that does not happen, the risk to this person is unlimited. Okay. The next one which we learned was long straddle, where market is swinging like this. You don't know where it is going to fix. So you will take a safer position this side and this side. That is why you will buy a put and you will buy a call. You will exercise it depending on where the market fix, right? And then covered put, here again it's just opposite of covered call, where you will short sell a stock, selling of a stock, and short put. Okay, your expectations are the market is bearish, so naturally you can buy the share at a lower rate and settle your transaction with respect to short stock. That's what you expect. Okay, now the next is synthetic long put. It's opposite to synthetic long call. What you have to remember is here there is short stock plus buy call option. Short stock is nothing but you are actually selling that without owning it, and to protect against the price rise. There is a possibility that price rise can happen even though you expect a bearish market temporarily. What you will do is you will buy a call option from the derivative market. So it's a combination of spot and as you say, the derivative market. That's why we call that as a synthetic long put. Now, the other one which we discussed here is the long combo. It is very easy to understand. Here, what you will do is you will actually sell the OTM put and buy OTM call. So you are actually expecting the market to be bearish in the short run, but you expect that to be in a bullish in future. So that's why you fix in a strategy where you're selling the out of the money put, right? See, when you sell this put, what you expect is this person would be exercising this out of the money, because now you could have sold this at 2050, but you are selling this at 19,900 because the share price can come up to this level, right? And what you have to remember is, if it does not come, if the share price is not coming down to this level, then automatically the person to whom you have sold will not be exercising his put. So you are in with the premium he has paid. Buy out of the money call, because you see that the market out of the money call means now it is available at 2050. You put the strike at 2200. So automatically what you're expecting is this person as you have bought the call, what you expect is you would be exercising this if the market is going beyond this. Right, if it is going beyond this, you are ready to exercise this by buying this, or else what you're going to lose maximum is the premium. So this is actually a covered position. That's why we say that at stock prices increase, the strategy starts making profit. Now the next one which we learned, the first one which learned in our class here is covered call. Covered call is nothing but, as I said, no, buy stock, you will buy the stock, you will sell call option, expecting that you are owning this, you're buying this. So what you want is sometimes you're selling the call option means if the share price is, if the strike price is no higher than the asset price as it is trading in the market, then what you expect is you expect to cover up this. But what you really have to understand here is this person is buying the stock to sell on a future day. But when he sell the call, he fixed the strike price out of the money, means this strike price is his profit expectation from this deed. That's why we call this is out of the money. The asset is available at 2050. He fixed this at 2,500 because this is the profit he expect by buying the stock from the market. Now, if somebody is willing to give him this, he is ready to exit from the market. So he expects the market to be bearish for some time, and he wants some profit to be made by, as you say, selling the call and getting the premium. But if the market is against his expectation, is bullish, automatically he is ready to exercise this at this price by selling the share, because that 2,500 is his profit expectation when he made a as you say, an investment here. It's a profitable break even. Why? Because as you know, the current stock price is 2050 is premium. The break-even point for him would be he received a premium when he sold the call, so it will be 1950, and if he is able to sell this price at 2,500, means he is earning enough and more profit. Maybe, as you say, no, it is more than 500, 550. So that's a good amount for him in 3 months period. We are not talking about single stock, we are talking about lot size. So that will happen in thousands. So that's a good condition for him, right? So that's why he has planned it in that way. And that is why we call that as the covered call. Okay, he's moderately bullish. He do not know, but maybe the market is going to taking the current condition prevailing in the economy. That's it. Okay. So in our class today, we had discussed total, if you total it up, 11 strategies that are followed by the option traders when they are trading in the market. It includes both covered and uncovered strategies.